have a question
I think everyone's going to have a very similar question.
about negative NPV?
Yeah.
What is your internal rate of return?
Leveraged 12.62
Mm-hmm.
and MIR 12.79.
And what is your required rate of return?
Yes, it's well.
Huh?
Yes, it is 20% as well.
So when your required rate of return is 20% and IRR is 13%, what do you expect for NPV to be?
Negative.
So you will think that it's in context with the videos we watched this week. You will think that when it's sensitivity analysis and you would pay to modify things, that would be where you would do one of those things. Like basically then just modify things. Quick question. I've done something and I've recommended it to these guys, which is when I was doing the assignment, gave my
Can we do it after? Because it's already at 1 o'clock. Well, this is our last review session, guys. Did you realize that? Official review session for which you get participation marks. So we almost made it. Next week we just have exam review, and for that there is nothing you need to watch. You have to do a quiz, which is comprehensive quiz, and it is worth more marks than your normal quiz. It has 10 questions in there, and you'll have to dig into your memory, going back to residential stuff, some from what we covered just recently, but it's a mixed bag of questions. So be prepared, look at stuff that we've done before, other tutorials, just to refresh your memory, because this kind of prepares you for the exam as well, because the exam is comprehensive and some of it you might have to do again there. For that quiz, you should have 5, just like with the normal ones, so you can do your first one, see what the questions are all about, practice them, and then go and you got still 4 more left to do it. Yeah, so I'm sure you'll get full marks if you leave yourself enough time. I know, of course, there is still a few things we need to do before you do this quiz, and that's the assignment. It is worth more than the quiz, so of course that's going to be your priority number 1 until Tuesday probably. So tomorrow I will be in the conference center, so bring your devices. If you have questions about the assignment, I'll be there to help you. Ideally, you will come with a model that's already completed. That way it will take just for me to come there, check your performance ratios, and off you go to write your executive summary. At least you know that you're dealing with the model that's correct, and you're writing an executive summary for a property that's performing what it is expected. how it is expected to perform based on the cash flows. So I'm going to give you some certainty, which is quite good that we're talking about risk today and certainty. I think risk is very exciting. That's what really makes the world go around. If we knew what is going to happen exactly, if we had 100% certainty about everything, I think it would be a very boring life. Wouldn't you agree with that? So risk surrounds us in everyday life. You get out of bed, you make decisions, and you don't really know what's going to happen to you today, who you're going to meet. There are some things that have complete certainty, like, yeah, surely the sun will probably be still there. But beyond that, we don't know. Who knows? I might have had something happen and I wouldn't be here today. So, yeah, so there's different levels of certainty, but definitely risk brings excitement into our life. And so with property investments, any property investment would have a degree of risk associated with it. And one reason for it is that we invest in real estate long term. It's not a one-day turnaround. And the longer you extend your expectations about your investment, the more and more assumptions you have to make. And the future becomes more and more obscure. And so property investment will be a mix of some things are going to be certain. For example, if you bought an asset, a building that's already existing, it's operating, it has tenants in it. If you have secured tenants that are good quality tenants, like say you have ASB Bank signed up in there, long-term 10 years, pretty much that gives you certainty in the rental cash flows. You don't have certainty about the capital appreciation of your property. You don't know where the market is going to go. So there is certainly going to be either partial uncertainty associated with that or just complete uncertainty. And so when we approach a property investment, you wouldn't want to step out, and if somebody told you, if you go out today, you're going to break your leg with 100% certainty, you probably would then stay at home. The more likely you will just kind of inside of your intuition, well, yes, I'll stay. I don't want to risk breaking my leg. So there are certain things, if you can avoid it, you won't do it. In property investment, there are things that you can avoid or you can mitigate and future-proof your investment so that it's resilient and it can adapt to changes. Even if it potentially can negatively affect your property investment, the way you've made that decision, it is able to adapt. So you want to not take risks you don't want to take risks that you know you can avoid. And in property investment, it's some of the risks you can easily avoid by doing a due diligence. And with any property investment, due diligence is a very important step. So you need to, basically due diligence is research. You're doing research about, you're collecting as much information as possible about the property, and you want to understand how it's going to perform for you in the future. And that can be just looking at the physical asset itself. Are there any cracks in the building? When was it last refurbished? To looking at who is occupying your building, looking at the lease agreements. And then you go beyond your building and looking at the market, at the economy, and how that might affect how your investment is performing. So it would have different levels of research and information you would have to collect. And this, once you have all of the research that you can, and all of the information that you can possibly collect about the property, you then evaluate your risks and make a decision. Is it worth for you to step into that investment or not? So that is where after you've done your due diligence, you're going to then determine, well, how much return do I need as a payback in order to get into this investment? So that is where you make a decision about the required rate of return. And this required rate of return is very subjective because it depends on the individual and their ability to take risk. Some of us are very risk averse and we want to avoid risk at any cost possible. And if we're forced to take risk, we will want to be compensated quite significantly for taking any risk. There are people who are risk neutral, and then on the other side of the spectrum, people who are seeking risk. And in this case, when you take a person who is risk averse and a risk-seeking investor, when they approach the same property that they want to invest in, their required rate of return will be completely different. And that's because for a risk-averse investor to invest in that asset, they'll want to be compensated a lot more because they're taking risk. Whereas for risk-seeking, they might be happy with a much lower return. So required rate of return, and therefore the worth of the investment, not the market value. I'm sure you've discussed these concepts in valuation, but the worth of the asset will really depend on how a particular investor would perceive the risk associated with investing in that asset. And if you know that if you take the cash flows that the property generates and you discount it, if you put in a discounted rate of return of 20%, you'll get one estimate of the present value. If you put in a 10%, it will give you a much bigger estimate of its present value. So you can see that the worth to an individual, it's a very different and subjective thing. Then with any real estate property investment, there is going to be a holding period associated with that, and you need to predict how your property is going to operate during that time that you're going to hold it. And of course, that is when the uncertainty part about it comes in. And the longer you estimate making projections about your property, the more uncertain that future becomes. And with any set of assumptions, as I said at the beginning, there is going to be different level of certainty, from something that you can be quite certain about to something you are completely in the dark. And that is only when you come to the end of your investment, that is only when you can actually say what was your actual rate of return, which can be very different from what you started off and what you thought you would get from this project with your required rate of return. And this is where the risk comes in, and that is the probability of actually getting the return that you desire. And when we have evidence about many projects about what investors were feeling they were going to get versus what they actually got, we can find then the trend between the variations between what we required and what we actually returned, and we can kind of, on average, estimate then what this type of asset, on average, returns this sort of, generates this sort of return. So what sort of sources of risk we have? Well, we can broadly categorize them into two camps. One of them is systematic, and one is unsystematic. So unsystematic risk is something you have control over and can, to some degree, change the outcomes. Whereas with the systematic risk, you have no control over it, and everybody in the market is going to be affected by those risks. Whereas with unsystematic risk, it's only your property is going to be affected. That's why you have a lot more control over those risks. If, for example, just in your student life, you're going to be taking well, we have students who are listening to what I'm saying right now on live stream. These students are taking a risk by sitting there. I mean, they put a lot of faith in the system working and that they will actually get their participation mark because they think that it's going to work. And most times it will work, but sometimes it doesn't. So those students who take the risk, they are exposed to systematic and unsystematic risks. So they don't have control over the internet and what might happen to the systems in the university. So that would be systematic risk. And unsystematic risk, well, they can control that by physically showing up to the lecture. And then they don't have to be exposed to that risk. So in property investment, systematic and unsystematic risk. With unsystematic risk, we're really talking about the business risk and financial risk, and from the lecture, there is also management risk. These are the sources that are kind of coming from within the property. So what is business risk? Well, by investing in property, you are in the business of real estate. And so the way you make decisions about how your business is operating, and in this sense, business is your property asset. The way you make decisions about that property asset is your business risk. And of course, some investors can make better decisions than others about how they operate their property. And again, it's important, in a sense, future-proofing your property. For example, these days, tenant occupiers, office occupiers, they want large floor plates. They want open floor space, no partitions. Well, if you build your building in the 1970s, 1980s, it was common to have individual offices and have columns all over the place. And, so it limits your flexibility in terms of how you can adapt to the future. So that is one source of the business risk, what you can do with your property. Financial risk really relates to your use of leverage, and we have seen that in the previous lecture about how leverage can affect your returns. And it can work both ways, can magnify them to make them bigger, but can also magnify your losses. But you can completely eliminate this financial risk if you don't use debt. With the systematic risk, though, you have no control over it. That's the government decides to make changes to the Residential Tenancies Act, and now every landlord has to provide, say, insulate their properties. So if you bought your house investment property 10 years ago, you weren't part of that legislation. You didn't know, so you didn't account for that requirement in your estimation of what that asset is worth to you, whereas those who are buying it today, when they're aware of that changes to the Tenancies Act, they will put that into account that, okay, well, if I buy this, I'll have to spend $10,000 on insulation. So they'll kind of include that, capitalize that cost into their offer on the property. So here's an example, and that is a building in Wanganui, in the very center of Wanganui on their Victoria Avenue. This is a building that's on the National Heritage Properties list, so it's recognized nationally that it's a significant asset. Was built in early 1900s, originally was Bank of New South Wales in there. So you would agree it's a nice building, character building. And in 2005, this building was purchased for $1.65 million. Between 2005 and now, there are certain events that happened that changed expectations of investors of what this property is worth today. For example, we had Canterbury earthquakes. Now, Wanganui is not anywhere close to Canterbury. None of the buildings during that earthquake collapsed or were physically damaged. But what happened as an outcome of the Canterbury earthquakes is the government put in changes to the Building Act, and there was an amendment to the Building Act that requires owners of unreinforced masonry buildings, which is, this building is a prime example of that, to strengthen their building to meet the requirements of the new Building Act. So now that is a significant cost for any owner, and that is the real cost that they'll have to undertake. Wanganui is located in a medium risk zone, so they have a little bit more time, say, for example, than people who are in high risk zone like in Wellington. So in Wellington, you have 15 years to fix your building. In Wanganui, it's a slightly longer 25-year time period, but it's still something real. If you don't do it, the government, the local government, will come after you, and you'll have to do it. So you're forced, you can't avoid it. So therefore, when a new investor comes in, they now price that expectation into their offer price. And you can see that just in 2018, it was sold for $1 million. And so that is just an example of how some of the systematic risks can affect the value of the property. I mean, physically, that property is the same. Nothing has changed. There's no damage to it. It's just the fact that now you have to, the change in the legislation pretty much overnight halved the value of your property. Just that. As an example also, here's something that was in the paper today. This thing is going to make your property worth $0 if nobody can buy it from you because you cannot get insurance on it. So that's a homeowner in Christchurch now, because in New Zealand, if you want to get a loan from the bank, you have to have insurance coverage on your property. If you don't have insurance coverage, then forget about getting a loan. So the only now potential pool of buyers for this homeowner is going to be cash buyers and people who are willing to take the risk and invest all of their equity into this house, because none of the insurers apparently want to touch this building. So that, again, something that is going to, this risk is going to devalue your property significantly. And it just happens, it can just happen overnight. You know, that something new, that you discover new information about the property. So that's, I think, more or less covers, well, as far as other components of that risk analysis, there's some stuff about doing sensitivity analysis, and that's what some of this was brought up by students with your assignment, that there are some students who are concerned that, for example, you have a negative NPV because your required rate of return is greater than the IRR. So it might be an opportunity for you to do some sensitivity analysis and change assumptions within your model. So let's say this is your base case scenario, that you think is the most likely outcome, how the things are going to go. But then you make adjustments to that base case and you change assumptions. Well, what are the main sources that would impact your internal rate of return or the net present value? Well, that would probably be coming from the rental income, from your debt service, and of course the required rate of return. But again, when you're making these assumptions, you have to be realistic. You know, you cannot make overly optimistic assumptions about your property. And then partitioning internal rate of return, that's another element of risk analysis. And just, you know, if when you partition your IRR and most of your return that you're generating comes from, say, appreciation of the value in your property, which is most of the residential property investors were kind of betting on in, say, previous few years. That probably is not really the case when property prices are flat, but when they're going up, up, up and away, if you calculate their IRRs, probably 90% of it comes from the capital growth. But capital growth is something that's quite uncertain, so you don't really want to make your investment decision based on such uncertain element in there. So really, rental cash flow should be the kind of the main source that's on which you're going to base your investment decision. And then capital gain is more of an icing on the cake, is how you should view it. So next, we just move on to the property development, project development. And in general, an investor has options in terms of strategies of how to invest in property. They can buy a completed, fully leased, income-producing property. They don't need to get involved in any aspects that comes before the building is already completed. Or you can get into a property development where you buy vacant land, or you buy a piece of land with improvements on it, but then you decide to demolish it, so in a sense making that vacant land and building something from scratch on that site. So that decision depends on how much risk you're willing to take. And again, that goes back to your risk tolerance, and probably a risk-averse investor would not get into property development where they have to start from scratch. They would rather get an asset that's already existing. They will take a lower rate of return, but at least they're satisfied that they're not taking on too much risk. But a risk-seeking investor would probably get involved into earlier stages of the development. So if we look at the risk return and the development stage, it is a bit of a busy diagram, but the red lines represent the level of risk during the development stages. So the earlier you get involved with the development process, the more risk you're taking on. There is a lot more uncertainty when you're dealing with a vacant site versus when you have an asset that's already operating as it's supposed to be. So you take on a lot more risk, but of course your expectations about the return are a lot more higher at that stage. And then there is also a difference between the different types of development, whether it's a build-to-suit type of scenario or if it's a speculative development. So a build-to-suit would have a lot less risk because you have a tenant that's committed to occupy your building. A speculative investment is something that you don't know who you're building it for. You're just basically hoping that you will get it occupied. And of course, for a speculative type of development, there is a lot more risk associated with that. But as you move along the development stage continuum, the timeline, there is less and less risk associated with that. And as at the beginning, you have to deal with getting all of the regulatory approvals, you have to design your project, and you have to put in a lot of your money because banks typically don't like to fund any of that upfront costs associated with property development. So when you're putting in your own money, you are requiring a much higher return on it than the bank would charge you interest. But once you have all of the approvals in place, you've secured financing, you've done all of the due diligence, then really it depends on how good of a main contractor you got. And here, I'm just saying risk is such an exciting topic. Just today again, another delay for our biggest project in the country, Commercial Bay. It's yet again delayed. So now they were promising for some shops and offices to open by December. Now it's not going to happen until earliest is March of next year. Yes. They've been promising that every year, but I'm sure March comes along and they'll say we might open by Christmas. It just tells you how fragile the construction industry right now, and you will have to take a lot of a buffer for these kind of risks in terms of construction. I mean, cost overruns, you've estimated what the project is going to cost you. You can easily double it, and you might stay within that budget. Time-wise, the same. You think it's going to be built in a year, but you'll be lucky if, again, in 2 years it's completed. It's just crazy, crazy times. So some of the risk, why it is high risk during the pre-development. Again, you can discover something that can completely kill your project. Here's another example, and for some reason it came again from Wanganui. But they've discovered some lethally high levels of arsenic in the soil, which put a complete stop to the project. So you were going all full steam ahead, finding your subcontractors and everything, and then this report comes in, and everything stops. Well, I can't tell you exactly, but there is a BP gas station next to it, so I don't know if that can be somehow related to it, but don't know. So what I want to also discuss briefly is the differences between how properties are financed. If you have an existing asset that generates income, and we've already talked about financial leverage last time, that leverage is a necessary evil for any pretty much any property investment. You have to use leverage because it requires such large commitments of capital. But you also, typically, there are also benefits of leverage, so you can increase your returns. But for a bank, when they're given a loan on an existing asset that has tenants in it that paying rent, they have a lot of security over that. So they know that it can generate income. If something goes wrong, there is an existing building that they can sell to somebody else and recover their loan. So therefore, they're willing to give all of the sum up front right at the beginning. So if you go and buy an existing building, you're going to have a big loan balance right at the beginning. But as time goes on, you're going to reduce it over time with repayments, regular repayments on that loan. So your balance goes down towards zero eventually. With construction, it's a completely different story there. You don't have an asset that generates income. All you're doing is you're putting more and more money into it for zero return while it's being built. So any construction lender is taking on a lot of risk by getting involved into this, because sometimes this, I'm sure sometimes you see abandoned projects that just don't happen for some reason. And then what do you do with it? Because there was an investor who had a vision for that site, and their vision was some office tower. A new investor that comes in and has to clean up their mess, they might not have shared that vision with the previous investor, and for them, They have to get rid of everything that's been built there before. They can't really get any money for the concrete that's been poured in the ground or any of the steel that's been put into the building. So you can't really recover much from an unfinished project, construction project. So there is a lot of more risk for construction lender going into it. Therefore, they're not willing to give you all of the construction costs required right at the beginning. So what they're doing is they're drip feeding the developer. So they've they cleared the site. Quantity surveyor goes in and says, yep, they cleared the site, it cost them $100,000. I can certify that. Then the developer can go to the bank and say, I need $100,000 to pay my people who cleared that site. Quantity surveyor approved that cost. Construction lender gives them the money. So now your loan balance is $100,000. Next, you started pouring foundations on the site. Quantity surveyor goes to the site, checks, yep, foundation's been poured, everything according to the plans. They're not suddenly building a round-shaped building when originally they were going to build a square-shaped building. So, yep, everything checks out. It costs them, say, $500,000 to do that. So the lender gives $500,000. So now the developer owes to the bank previous $100,000 plus whatever interest accumulated on the $100,000 plus $500,000. So the balance is $600,000 plus some interest. And so that continues. And at the end of the construction process, you accumulate a big balance. So a complete opposite of what you have with a typical permanent or investment loan, where you have big balance, you come to zero at the end. Here you start with zero and you end up with a huge balance at the end. So you need to have a way out when you finish your construction. And it depends on what your strategy with that development. If you're going to sell off your units, for example, you're building apartments, you have buyers lined up. So once you get your code of compliance certificate from the council, you're all clear to sell your units. Once you've sold all of them, immediately you're going to go and pay off your lender, construction lender. That's it. Your debt obligations are over. If you decide to hold the property and say you've built an office building and you have tenants occupying it, your rental amount is not going to cover all of the construction costs that you have done. In the first month, you get just a fraction of what it cost you to build that property. So what you're going to do, you're going to go in and negotiate an investment loan or a permanent loan on your property. So you'll have this permanent lender come in and take out the construction lender. And so you just switch lenders from having a construction lender. Developer now have to start paying off their big loan balance to a new permanent lender. So another point of difference is that for a permanent or an investment loan, there's payments constantly, not constantly, but say monthly, regularly going to the lender every month, 2 weeks, or whatever. With a construction loan, zero payments go to the lender. And you would have, if you have started your assignment, during the development process, you're making no payments. All you're doing is you're accumulating interest. Okay, well, that covers the risk and development, and we still have time for Kahoot. Okay, we're starting. So the key to managing risk is diversification. And if you have a mix of growth assets and defensive asset classes, you're able to manage your risk associated with investing. So yes, when you're investing across different asset classes, you diversify and improve your chances of getting a return, desired return. Yep, very good. So due diligence would be part of the due diligence during acquisition of a property would involve looking at property service. How often have you had the plumber come out to the property, constant leaks happening, or do you regularly maintain it? That would reveal a lot about that property. So important in mitigating your risks. So it is a base case. Yes, so you set a base case for which you then test sensitivity. So base case would be your most likely outcome, and then you start changing either one assumption at a time or a set of assumptions, because it might have a flow-on effect on your performance. So it might be better to take a set of assumptions and change them for your sensitivity analysis. And so go see how your results differ from the base case once you start changing things in it. So business risk, we already mentioned that, is your decisions about how your property operates, what cash flows it generates, and of course, if there is a growth in employment, that means businesses are growing, they need space to locate in a physical property, so they will need space, yes? Business risks are about your property operation. Yes, so if you have demand for your property, then it will help you reduce your business risk. So if you read any of the Real Estate Institute New Zealand reports, the two key statistics that they report in it is the average days to sell and how many properties have turned over this month. So that is an indication of kind of the health of the property market. The longer it takes you to sell your property, and that kind of sends certain signals to the buyers that perhaps what is wrong with it. So if your particular property, if it's just your particular property that is not selling, but others are selling, that might be a different story. But sometimes when nothing is selling, it might affect you as well, and it increase your liquidity risk. And of course, real estate is inherently very illiquid, but you can make it even more severe during certain times of the market cycle. Well, if you own a rental property, this is something that you can't avoid. You have no control over it. So this is going to affect the legislation risk. Management was quite a popular, I see, but management is about, say, the quality of tenants you decide to put into your property, or the length of your rental contracts. That's more the management side of it. But really, every investor in the market is going to be affected by these changes to the standards. So it's a legislation risk. So if real estate is not leveraged, then you would have no financial risk. But even if you are not leveraged, you will still be affected by interest rate risk. So the answer is false. It will have interest rate risk because if you decide to sell your property, the investor, the new potential buyer that comes in, they will have their expectations about required rate of return, and the prevailing interest rates in the market will have an impact on their required rate of return. So this would affect the delivery risk. Project risk would really more about checking the feasibility of your project, whether it makes sense for the market to be bringing that project at this point in time. But delivery risk, it's actually, can you deliver this project on time within budget? And having a guaranteed maximum price contract from your main contractor at least guarantees that any cost overruns is not going to be your responsibility. So that your cost should not exceed that maximum price. Settlement is the type of risk that you can mitigate if you put in certain clauses that allows you to delay your construction. So for example, sunset clause is one of the examples that allows the developer to extend the date by which they promise you to deliver a certain project. And this is something that's happening, for example, with the Alexandra Park development down in Epsom, Green Lane, yes. They had to use this sunset clause, and they already passed that anyway, and they were begging their potential buyers to stay with them. So construction lender only commits to a certain amount of funding. And if you have cost overruns, that have to be covered by the sponsor of the project, who is the developer. So they need to have cash on standby to cover any overruns. So if they know that the sponsor has sufficient funds, then that certainly would mitigate the sponsor risk. So let's have this as the last one, last question. So when it's just develop and sell, you're not going to hold on to your development, you're not going to manage that development. All of the proceeds from the sale will go straight to your construction lender, and you don't need any other sources of financing arranged. So that's, I'll see you tomorrow, some of you anyway, and good luck. Yes.